Hello, landlords and property investors. Are you earning rental income but unsure how it impacts your taxes? Understanding the tax implications of rental income is essential for remaining compliant and optimizing your returns. Whether you rent out a single flat or manage multiple properties, knowing what's taxable, what deductions are allowed, and how to report income accurately can significantly affect your net earnings. In this video, we'll walk you through the critical aspects of rental income taxation, so you can avoid expensive mistakes and improve your overall tax efficiency. What qualifies as rental income for taxation. Rental income is more than just the monthly rent collected from tenants. It also includes advance rent, non-refundable security deposits, and separate charges for services like maintenance and utilities. Even if a tenant pays directly for services on your behalf, such as repairs or improvements, those amounts may be treated as rental income by tax authorities. Timing is key too. Advance rent, even if meant for a future period, is usually taxable in the year received. Fully understanding the scope of what counts as rental income will help ensure proper reporting and reduce the risk of compliance issues. 2. Reporting rental income correctly. Once you've identified your sources of rental income, accurate reporting is vital. In India, for example, rental income is typically declared under the income from house property category in your tax return. Misreporting or underreporting rental income can lead to penalties, interest charges, or even legal action. It's advisable to use reliable accounting tools or consult a tax expert to make sure all rental earnings, from digital payments to cash or bank transfers, are properly documented and submitted in line with local regulations. 3. Claiming deductions to lower taxable income. The advantage of renting property is that many expenses can be legally deducted from your taxable income. These include property taxes, insurance premiums, repairs, routine maintenance management fees, and even legal or accounting charges. In certain tax systems, depreciation on the building's value can also be claimed annually. These deductions help to reduce the portion of your income that is subject to tax. To make the most of these benefits, it's essential to keep detailed and verifiable records for each expense incurred during the financial year. For simplifying with standard deduction options, to reduce the complexity of itemized deductions, some jurisdictions offer standard deduction on rental income. In India, landlords can claim a flat 30% deduction on the net annual value of property, regardless of actual maintenance expenses. This approach is beneficial for those who have minimal spending on upkeep or prefer not to track each item individually. However, understanding when to opt for standard deduction versus itemized expenses is crucial, as it directly impacts your tax liability and potential savings. 5. Tax on vacant and self-occupied properties. Even if your property is unoccupied or used by you, tax obligations may still apply. In many countries, you can claim benefits on self-occupied properties, especially for home loan interest. However, when you own multiple properties, only one can usually be classified as self-occupied. Others may be taxed based on a notional rent value determined by market rates. This means tax could be levied on vacant units as if they were generating income, making it important to understand how ownership and usage status affect your tax responsibilities. 6. Loan deductions and their tax impact. Home loans on rental properties can significantly affect your tax situation. Interest paid on such loans may be deductible under provisions like Section 24B. In India, up to a specified limit. Meanwhile, principal repayment qualifies under Section 80C, subject to annual caps. These deductions provide substantial relief on taxable income. However, to qualify, you must maintain documentation such as loan statements, payment receipts, and construction or purchase completion certificates. Ensuring your loan documents are in order will allow you to claim these benefits without hassle. 7. Understanding GST on rental income. Goods and services tax GST can also play a role in rental income. While residential rentals for personal use are generally exempt, leasing out commercial property or residential property for business purposes may attract GST. If your overall rental income exceeds a government-specified threshold, GST registration and compliance may become mandatory. Keeping track of rental income type, tenant purpose, and total earnings will help determine your GST obligations and prevent unexpected liabilities. 8. Capital gains tax when selling your property. If you plan to sell your rental property, any profit made is likely subject to capital gains tax. This depends on the duration of ownership. Properties held for a short term, less than 2 years in India, incur short-term capital gains tax at standard rates. Long-term holdings, however, enjoy reduced rates and may qualify for exemptions, such as reinvestment in another residential property or specific tax-saving bonds. Knowing the difference between short-term and long-term gains allows you to time your sale strategically for tax efficiency. 9. Importance of keeping financial records. Maintaining detailed records is essential for both reporting income and claiming deductions. Documents such as lease agreements, rental receipts, maintenance bills, loan documents, and utility invoices form the backbone of your tax file. During audits or tax assessments, these documents serve as vital proof. Using digital tools like property management software not only improves organization, but also ensures you have access to everything when needed. Proper documentation also enhances transparency and helps track the financial performance of your property. 10. Why professional tax advice matters. Navigating the tax landscape for rental income can be tricky. Tax rules vary by location and often change over time. A professional tax consultant helps ensure you're compliant, maximizing deductions, and taking advantage of all eligible exemptions. They can also help structure property ownership in a tax-efficient way, offer guidance on GST registration, and provide insights into future implications like capital gains. Partnering with an expert can ultimately save you more money than it costs, making a smart move for serious property investors. Bonus tip: how SANGAU supports your tax compliance. At SANGAU, we know that successful property management goes beyond collecting rent. It includes staying compliant with tax laws and securing your financial interests. Our comprehensive services are designed to assist landlords with rental income tracking, expense documentation, and generation of reports for tax filing. We work closely with legal and tax professionals to offer guidance on GST, depreciation, and home loan deductions. By partnering with SANGAU, you ensure that your rental income is handled professionally, leaving you with peace of mind and maximize returns. Thank you for watching. If you found this video helpful, please like, share, and subscribe to our channel for more expert tips on rental income tax, property management, and real estate investments in Bengaluru. Stay informed, stay compliant, and we'll see you in the next video.